So, hello. I hope everybody's having a great day, whatever you're doing. As usual, no trade calls, no recommendations, no response for their own stuff. We're here for educational purpose only. And I'll go through a couple of things here just to look at the main major markets. And then I'll be open to taking any questions. We can cover anything. And just let me know what you want to cover. And we'll stay on as long as there are questions to cover. Okay, so where are we and what is going on? So again, an awful lot of event risk this year, or headline risk rather. And as I've been saying also in those Substack chats in the morning, I think this year's probably going to look like a walk in the park compared to the other years, last year's. So in general, what that means to me is that I'd be very, very cautious holding overnight positions. In anything really, right? I'd prefer to be a lot more tactical this year. Now, where are we trading? Well, right here, more of the same. And that could be a little bit of an issue, right? Because consensus across the board, whether you're looking at the majority of intraday traders, institutional traders, or, house views, is more of the same like last year. So gold higher, dollar down, stocks higher. So everybody's on the same side. So clearly, it's unlikely that we continue to analyze this year based on the start of the year. As usual, we're very likely going to have 2, 3, 4, 5% corrections, a couple of double-digit corrections. And so it just means that there's an awful lot of trade to be done. And you want to be a little bit careful earlier on in the year, right? Also because, as we say, the year doesn't really start until we get through Martin MLK weekend next week. So you just want to be a little bit careful, and also keep in mind, for those of you who like to track seasonals and stuff like that, that we are, in terms of the presidential cycle, we're in a midterm year, right? So that's the weakest year of the 4-year presidential cycle, and that's also the one with the biggest drawdowns. So you want to be a little bit careful. Looking at ES here, what's happening on ES? Well, clearly we're still in a rotation higher, right? So nothing much has changed. What is interesting, if you were to dig down in a little bit of detail, if you were to draw basically a little bit of a range here at the first day of the year, and you can flip it on a 1-hour chart, or you can easily see it here, is that we chopped around on the second day. The high was defended, and then after that, every dip, you're getting this confluence of the range high of that first trading day of the year and the 10-day moving average, and that is being supported, right? Add to those 2 points the fact that we're back above this high, you're getting an awful lot of bullish confluence. So here the market is telling you it's trying to grind higher, and it's really having trouble finding any aggressive sellers. And even today, after the shenanigans with Powell, market came in and bought it right back up. Now, clearly, on an intraday basis, as long as we're still inside yesterday's range, much to do about nothing. We'll have to see. But I think the key thing, and again, these sessions are just to look a little bit of the bigger picture, is that once again we're trading above this previous high, all-time high, number one. Number two, the market is getting bought and supporting the 10-day moving average. And number three, that opening day range of the year is being supported too. So clearly, unless the market trades below that, this is still a very bullish configuration. And in this kind of context, any new high possible, especially as we move into earnings. Okay. So as I said, I'll cover the major markets. So let's look at TLT. TLT, what's happening? We're kind of stuck here, right? You can see we're clustered around the 2025 open, 2026 open. And here, again, unless we get a real catalyst, market is very likely trying to hug this zone. Now, the bulls were focusing on this aggressive attempt to break higher, which broke down with this spectacular gap down here, and the break is holding. And the bears are still counting on the fact that this big pivotal level around the 90s is still being defended. And right now, what they're focusing on is this series, this rotation lower. I think basically there are far more interesting things to trade here with an awful lot more edge. And unless there's a big catalyst or a big, again, headline that gets this going, then I'm not too interested. Ideally what you see is some strong catalyst or headline that sets up a break to play for a move back into those highs, or break down and it plays for an unwind of this whole move back into the lows. But as long as we're trading inside this choppy zone, as long as we're stuck around the 2025, 2026 open, really there's no, okay, you can trade intraday, but bigger picture, which is more the purpose of this webinar, there's not that much going on. Third, we'll do the 6 major markets. Third is the DXY. And here, we were talking about this last week also on Twitter and stuff, the fact that when you come into December, into January, usually seasonals tend to be fairly weak for the dollar in December. And especially when you have a December where those seasonals, the weakness really gets stretched, the most interesting trade is to play for a little bit of mean reversion as the year starts. And that's essentially what we got last week. If you see the weekly coming into this year, that's what you got, a little bit of that mean reversion. Now here, a lot of players were probably going to be, I suspect, talking about some kind of cup and handle formation here. I'm not a big fan of these, but right here, what I would say, and again, this is likely going to be stuck with those bonds, is that unless we need a strong catalyst to get it back above that 100, and we discussed this a lot last year, how this is really a ball underwater level, and that if we can get traction above, then that really opens up a bigger move, 103, 106. But below, pressure is on, and it opens up an awful lot of air pockets to the downside. So if I just step back a little bit here on the chart so you can get a better picture view, is the action, most of the action is really framed around this 106, 103, 100 range. And that's a very nice tradable range. And what's been very tradable for a while now, essentially since we entered in that back in 2002, is breaks and fails outside every time we, not aggressively on the break, but once we come back inside to play for the opposite side of the range, or even here aggressively. So right now, I'm not a fan of playing for a breakdown here where you have this kind of basing pattern forming. So what I'm looking for is either opportunities to, and I've been trading this tactically, last week, but again, if we're talking for bigger swings, I'm looking for either a catalyst buck above the 100 to try and spark this kind of move when consensus trade is clearly still short dollar, or should something nasty happen apart from a tactical move here, then it would really get interesting on a complete disaster situation breakdown below 97. But if you see the way the market is reacting even here to the Powell news and to everything, chances are it's going to take a lot for us to break outside of this range. Now, again, we got a lot of key data points this week. We got a 10-year auction today. We're going into earnings. We'll have to wait and see. But that's pretty much where we are here with the dollar. So ES done, DXY, TLT done. Let's look at crude. What's going on crude? Here, crude, I think there may be something interesting here around the 60 level mark, but ultimately this is a hard play, right? I suspect that the powers that be want this to stay heavyish, at least until we get through midterms. But the issue here really becomes a big, a difficult one, because you have to find a way of sizing that position to get decent risk reward, because if you're playing for a breakdown, sure, you can be playing for the 50s, but are you going to get aggressively short into all these lows? No, you probably need that. You need to initiate that trade lower, right? And equally with all the things that are going on, all the headlines, do you want to be looking for aggressive longs? It's really hard because the stop placement on that is particularly hard, right? So unless you're looking at some other kind of way of expressing the trades, directional trades are a little bit tricky. But right now, especially if we get a little bit of traction, day closes, weekly closes above the 60, it looks like it might try and pop at least back into that 200-day. But, definitely a lot of pressure, probably on a catalyst, on a headline, upside Momo chase, on a good run, even missing the first $2-3 could be interesting in terms of bigger picture view. But again, gun to the head, I would expect that this may be a story, unless there's a rogue headline. This is a story for after midterms. So ES, TLT, DXY, CL, let's do GC. So GC here, I mean, this is as textbook as they come, right? We talked about this a lot on Twitter too. Really, no edge being short gold for tactical plays. That seasonal's played out. What we always look at is that bullish stretch, December, January, February in gold, trying to get long on any weakness in December, then holding through the year through January and exiting in the first part of February, and that trade is still in play. But here, the way this is trading, there's little reason to want to scale out of these positions. I'd just be trying to trail stops. Now, the other thing which is particularly interesting here psychologically is, remember, there are two key reference points. One is that weekly range, and again, we broke out of it and we're extending. And the other thing was the holiday massacre on the hiking of the metal margins. And here the market is very, very clear, right? We discussed this even last week, is on that press lower. Well, the 2026 open held, we bounce right back above that weekly range. We bounce back above the 10-day moving average. We broke the 50% retracement of the move down, which usually means that we'll tend to tag the 61.8. Then it means that we tag the 78.6, and this is extending higher. So as technical as it comes. So here really, especially here, as long as it holds above this, there's really much to do about nothing. It's a tricky one, right? Because you could also always get another margin hike, whatever. But, really, unless this trades back inside this broader range, any dip is likely going to get bought. And even if you look at it bigger term, this could retrace a hell of a lot and still hold a bullish upside structure. So again, this one's probably one of the clearest charts out there, right? Probably one of the clearest charts out there. How have you been expressing that DXY trade? Last week, I was just basically scalping euro. I had some trades also but nothing major. Not holding any swing. As I said, I'm trying to be a little bit more cautious and even more tactical this year. So I'm not carrying much in terms of overnight risk, or as little as possible. So ES, TLT, DXY, CL, GC, let's do Bitcoin in terms of the last major market. And again, I'm being very, very kind here, including it in the major markets. But so here, what's happening on Bitcoin, absolutely not much at all. And if you also look at it in terms of flight to safety, it's not getting that bid you would expect. What we discussed here, this breakdown was very, very technical. And our base case expectation was that as long as it held below that 100, there's a potential for an unwind back to 74,000 and 69,000. And those levels are still in play here. I think it's quite telling that every bounce right back into the 2025 open can't get any real traction, even when you're seeing a kind of flight to safety bid coming into gold, silver, and other stuff. So this is really a key level. But more importantly, I think that it's kind of like the 420 on Tesla, right? It's a key psychological level. So I think here, unless it can recover that 100K mark with gusto, and ideally on no real headline, right? Then it stays heavy. Technically this could rally all the way back into the 110, and it's still a little bit tricky. So we'll have to see, but there'll be a lot of positive catalysts, and it can't seem to rally. So it doesn't bode that well. But part of me thinks it's also just not an awful lot of interest. People are focusing on other stuff. So I think you have to keep. Hey Knut, how's it going? You have to keep an open mind. But clearly it's not getting the reaction you would want to see. But the other thing to point out psychologically, which is interesting, is, remember that all the shenanigans and all the euphoria the last quarter of 2024, here, really, apart from this lot, most of the people that bought all the breakups are underwater. So I think psychologically that 100 mark remains extremely, extremely important to breach, to kind of flip a switch. And equally, if you're talking about, psychological confidence and stuff like that, you can look at strategy, right? And, we've been talking about this inevitable unwind for an awful long time. But here, it's the same thing. It's just can't find a bid. Even the other day when you got the news that they weren't going to be delisted, you had a little bit of a green day, but it's still not catching a bid. So I think there's just very, very, very little interest. So I think you have to be very, very careful here. And especially in a market where everybody's is positioned on the same side of the boat, looking for, equities higher, dollar lower, free ride, economy's going to be running hot, rates are going to come down. If you get a little bit of a curveball thrown at that thesis and you see a little bit of a flight to safety, a little bit of a de-risking of portfolios, etc., that's not the kind of environment where you would see that, flows going into speculative crypto. So I think you have to be particularly careful there. There's still an awful lot of risk. So that's what I'm looking at in terms of the major six markets. If anybody has any comments or any questions or anything you want me to cover, shoot. I'll give everybody a little bit of a chance to go through those things. I'll talk through a couple of other things which I think are interesting. Here, going into this week, we're starting to see earnings kicking off, right? So as usual, the meat of the earnings season kicks off with the banks this week, tomorrow, and also TSMC at the end of the week. So I think what's going to be interesting is, clearly SMH into the end of the week, but also XLF. So one thing, as usual, when you go through earnings, don't get too excited about all the moves or what you may see from an intraday basis or in terms of the gaps. You want to focus on how we trade into the close of the following day and into the end of the week. So here on XLF, you could see that markets kind of spent an awful lot of time stuck, having trouble at these highs from 2024, struggling in early 2025, and then finally breaking through in December. But right now, it's similar to the breakout you've seen on a lot of things. But what happens here, because the market has spent so much time in this zone, if we come here, this is more of a chart that's moving higher. So any dip is a clear buy into a kind of rising channel, a series of higher highs, higher lows. Here it's a little bit different because on any dip, it will go right back into a range trading scenario. So I think you don't want to be as excited as you would normally be if you get a down move in terms of traction, because it's not a pure long uptrend. It would be a break back into a range. So the only thing I'd want to say here is clearly above here, this remains bullish, but don't forget that in all this zone becomes very, very neutral, and then it becomes very red below. But don't forget this neutral zone, right? And what most people will be looking at is JP Morgan, and you see also that familiar kind of area on JP Morgan. And we'll have to see how it trades. But remember here too, this is a big neutral zone. The configuration is slightly different because here you've got that 200 DMA that's coming in, protecting these previous highs, protecting the range low, than you do on XLF. But still, you get the point about that range. What a lot of other people are talking about, I assume these days, is silver. Now, some of the moves on silver have been absolutely nuts, and I know a lot of junior traders are not used to trading these and they just think it's normal. But you've had crazy up, down 5, 6, 7% moves. This is very, very crazy, especially if you're, you can really get caught off guard here. You have to be very, very careful. But you can see how every dip is getting bought, how technical it is, how the 2026 Open is being defended, how that 10-day moving average is being defended. So remember, these are very thin, illiquid. You have physical issues here. Just be careful. But there's really, the market's very clear. Even the reaction we saw overnight, even when there's a little bit of a headline, what are people doing? People are continuing to sell the dollar, piling up on metals and selling risk. But then once the intraday YOLO is coming in, we hit back the bid on stocks. We unwind a little bit of the FX move, but what doesn't unwind is just that constant bid in metals. So you just want to be very, very careful there. You don't want to get in trouble trying to fade these moves. Life's too short. Life's too short. And that's pretty much it in terms of the big themes. Again, if anybody has any questions, I'll stay on. If not, there's really not that much going on. We can look at some of the tech names, but you could see that rotation out of big tech into other stuff. NVIDIA really hasn't gone anywhere since August 2025, right? We're still stuck there. You've got Google, again, the headlines, this really continues to go crazy to the upside. You've got Apple kind of stuck at this previous high. This is a big pivotal level, kind of waiting for everything else. Doesn't really know what it wants to do. Amazon's recovered this big sideways range. It's going to have a tough time, I think, chopping through this reversal zone, but this is going to be a very interesting area. Microsoft still not doing much, looking fairly heavy. I think right here it's going to become a range trade, right? You've got this range, which is very, very tradable. Above opens up an awful lot of gap fills to the upside, and below opens up an awful lot of gap fills to the downside. So you've got upside, downside plays through this range, which creates fairly nice asymmetry for risk-reward placement. Facebook not looking too good. Tesla still bullish, still above the 420 mark. Broadcom trying to recover, but this one doesn't look that healthy. Palantir still stuck. Probably have to wait for earnings here, but this looks like it's really struggling. It looks like it wants to come back down into the 200. AMD trying to find here, kind of like some kind of triple bottom action. We know there's no such thing as triple bottoms or triple tops, so you would expect that low to get retested maybe through earnings. Netflix is just a complete dog. We had a beautiful call here for a move back into that 2025 open. We got there. We're expecting that to happen earlier, but trying to hold here. Clearly, you wouldn't be pressing the short side here, but that's pretty much what's going on here. I think you just have to be, again, I'd like to reiterate that you want to be very, very careful on overnight risk here. Very, very careful on consensus trades. And luckily enough, despite that, the market has been extremely technical. It's like today you had, on the overnight ramps, you had Euro reversed exactly where you would expect it to reverse at a DR3. You had cable reversing exactly where you'd expect it to reverse, holding an R3. We often talk about the fact when you get those gap opens on Sunday, you usually wait for some kind of basing action at previous day low into London, and you trade for a move to fill the cash gap long. That played out, the long played out beautifully on ES today. So I think it's going to be an extremely hard year for people who have a persistent bias or want to be aggressive, looking for big swings. I think it's a year that's going to reward people who are very tactical and keep a lot of powder dry and don't hold an awful lot of overnight risk. And if you look at some of these moves, which are very, very aggressive, what that does is that really offers you the possibility or the opportunity to, I know this may sound strange, but widen out your stops, widen out your TPs a little bit and trade smaller. And I think that's a very nice scenario. So that's what I'd be looking at. Thoughts on JPY? I think here on JPY, we have to wait till we get, we'll see this week with the earnings, with the bond auctions, but we have to wait till we get through all those 2 weeks when we have all the central banks, the next BOJ meeting. Keep in mind that the whole unwind on the BOJ is, a multi-year thing. So, it's very, very gradual, and they're going to be very, very careful about causing a little bit of a shock to the market. I think if you're looking for a little bit of a more hawkish BOJ or a little bit more of an aggressive move on yen, what you really need and what you really want is U.S. markets to continue to stay aggressively bid, right? So as long as U.S. or risk in general is aggressively bid, then there's a higher chance of BOJ being aggressive, being a little bit more hawkish. But as we saw, with the news last week about, early elections and things like that, it just makes the picture extremely messy. So usually we get an awful lot of verbal intervention around the 157 mark, and we haven't seen anything yet here, which is a little bit surprising, maybe. But I think, as always, what you want to look for is, if you're waiting for those headlines to hit, remember the slow, gradual move higher of USD JPY is not as big as a problem as a stupid, aggressive move. What really matters is velocity of move, okay? So right here, you're really watching for potential verbal intervention for tactical trading opportunities. But remember, tactical intervention usually doesn't stick, right? Even broadly speaking, even the real intervention is had trouble. But so that tends to be good for scalps. If you're looking for a big swing move or a yearly swing move, like we looked at last year, that we flanned out into April, May, the conditions aren't ideal right here. The conditions aren't ideal for that yet. So I think you want to be more focused on tactical trades if you have to. And as far as I'm concerned, there is, despite the fact that we had previous intervention at the 160, close to the 162, there is absolutely no level where I want to have an order in the system waiting to short, because I don't want to get run over, right? So what I'm doing is I'm either tracing specific zones, looking at the round numbers, and waiting for tactical reversals on shorter time frames to maybe give me a chance to try and nibble and get into a position, get risk-free and hold partials, or I'm waiting to try and take advantage of a headline. But remember, you have to be very careful with a slow grind higher market. And in general, the slower it is, the slower it's grinding higher, the last thing you want to do is just blindly fade. You want a catalyst or you want a technical reversal. Selling for the hell of it is a recipe to get into a lot of trouble. So either you're waiting for a tactical level and a reversal on a shorter time frame, or you're waiting for some kind of a catalyst and you're happy missing a little bit of the move. Now remember, as long as you're trading tactically, what matters is the risk reward you're trying to get on the specific trade you're trying to express. If you're talking about a bigger move, back into the 120s, 130s on something huge and structural, that's such a huge move. Who cares if you miss the first 200-300 pips, if you see what I mean, right? So no hurry. No hurry. That's the thing. And especially, I can't stress this enough. One of the best advice I could give anybody is never feel in a hurry to do anything in January. There's plenty of time to make money and plenty of time to lose money this year. The last thing you want to do is overtrade or get into trouble in January. It's just simply not worth it. Any other comments? Any other questions? Any other pair anybody wants me to look at? Okay. So good stuff, guys. Thanks for stopping by. I'll post the recording. Have an awesome one and talk to you guys soon. Be careful. Be cautious. Again, no need to be a hero. Take care. All the best. Bye-bye.